In the previous video, we looked into the different forms of businesses, their limitations, and the advantages of company form of business. And also we looked into the different classifications of share capital and the differences between equity share capital and the preference share capital. Now let us look into the issue of shares. Firstly, issue of shares at par. Now this is a crux, meaning this is a standard format which you can use to solve problems based on this type of adjustments. The first stage in any issue of shares would be receipt of application money. In this example, A limited company issued 1 lakh equity shares of rupees 10 each at par. Application money being rupees 2. Okay, it's because the company sometimes might not require entire amount in one go. Therefore, it will allow the shareholders to pay in installments. We are assuming that the company has received applications towards 1 lakh equity shares. So in that case, the company would have received 1 lakh shares into rupees 2 per application money. Therefore, it would have received 2 lakhs. When the company has received 2 lakhs, its asset, that is bank account, is increasing. Therefore, the entry in this case would be bank account debit 2 lakhs to share application account 2 lakhs. Bank is an asset which we already know. If an asset increases, we have to debit it. Likewise, share application is a liability because we have received the money but we haven't yet allotted them anything in return. Therefore, since liability is increasing, the same has to be credited. Once that is done, once we receive the amount, we will now be able to allot the share capital. Since we have received applications to the extent of 1 lakh shares, we can now allot share capital to the shareholders to that extent. Therefore, since share capital is being allotted and the capital rule says if there is any increase in capital that should be credited, we will credit share capital account and debit the share application. This was a liability which we had credited because it increased, and now the same liability is getting reduced because that liability is now getting transferred to share capital account. Therefore, debit share application to share capital account 2 lakhs. Let's say the company, instead of receiving 1 lakh applications for the shares, receives 1,50,000 applications. This is a classic case of oversubscription. That means they will ask the shareholders to apply for 1 lakh shares, but they receive more than 1 lakh shares. In such cases, the company would have to refund the excess amount which it has received. So if the company is refunding such excess amount, the entry would be debit share application account 1 lakh to bank account, because share application is a liability which is getting reduced here and bank account is an asset which is reducing because we are returning the money to the applicants. Continuing the above example, if the company calls up the allotment money of rupees 3 per share, out of 10, rupees 2 has already been called up by way of application, and the next stage is allotment money, wherein the company is asking the shareholders to pay rupees 3. By now, we already know that we have 1 lakh applicants who have already paid the application money. Now we are asking them to pay allotment money. The moment we ask them to pay allotment money, we can create a due entry, meaning so much of amount is due from them. So the due entry in this case would be share allotment account. It's an asset which we are creating temporarily until we receive the money from the shareholders, and credit share capital, because once we receive that money, that will anyway go to share capital itself. Since capital is getting increased, it has to be credited. Now once we pass this entry, after some time the shareholders will pay the money. Once we receive the money, then we will have to debit bank account because we are receiving the money now. So asset is increasing, so debit bank account, and credit the share allotment, that is the asset is now getting reduced. So we had created 3 lakh asset. Since we have received 3 lakh amount, that asset will now get nullified. So next would be the first call. So we have already received 2 rupees as part of application and 3 rupees as part of allotment. Now would be the first call. In this example, the company has made a first call of rupees 3 per share. So if the company is making a first call, once again there will be a due entry because company is supposed to receive that much money from the shareholders. It will be very similar to the above entry, except that instead of debiting share allotment, we will now be debiting share first call account because the money is due towards share first call account. Once again, 1 lakh shares into rupees 3, 3 lakhs debit increase in asset, and credit share capital increase in capital 3 lakhs. Once we receive the money, once again we will have to debit bank account, debit 3 lakhs. Because we have received that much money, and since this asset is now getting reduced, credit the decrease in asset, share first call account. The last stage in this example would be the second and final call, because As part of application, we have received 2, and as part of allotment 3, and as part of first call, we have received 3 once again. So 2 plus 3 plus 3 has already been received. That is 8 rupees out of 10 rupees has been received, and only 2 rupees is pending from the applicants. So now the company has made the last call, that is second and final call. Once again, we'll have to pass the due entry, share second and final call account, 1 lakh shares into rupees 2 lakhs, temporary increase in asset, so debit. To share capital account, credit increase in capital. Once we receive the money, debit bank to share second and final call account. Since we have received the money, debit increase in asset. In the previous example, we looked at the issue of shares at par, wherein 1 lakh equity shares were issued at rupees 10 per share. In this example, let us look at the issue of shares at premium. That is where the issue price is more than the face value. So we'll take the same example, that is 1 lakh shares, but instead of being issued at rupees 10 per share, now it is being issued at rupees 11 per share. So therefore the issue price has now become 11 as against the face value price of rupees 10. Therefore the difference of rupee 1 will be treated as securities premium or premium on issue of shares. Note that the application entry, that is both receipt and allotment of share capital, will remain as it is, because if nothing else is mentioned in the problem, we are assuming that premium will always be collected as part of the allotment stage. Therefore, the entry in this case would be share allotment account, because it's an asset which we are creating, as that much amount is due from the shareholders. 1 lakh shares into rupees 4 per share. Instead of 3, now it has become 4 because there is premium of rupee 1 as well. So 4 lakh is the amount due from shareholders. But towards what? Now we have to split that into 2 items. One is securities premium account, because the amount collected as premium should be transferred to this account. This is a liability as we had discussed in the previous video. So since it's a liability and since it is increasing, it will be credited to the extent of 1 lakh into rupees 1 per share. That is 1 lakh rupees itself. And lastly, credit share capital as well, because we have to allot capital to that extent. Out of that 4 rupees, 3 rupees goes towards capital. Therefore, since capital is increasing, we have to credit 3 lakh rupees. Receipt entry for the allotment will remain the same as well, because we would be receiving 4 lakhs as against 3 lakhs in the previous example. The entry would still be debit bank account, credit share allotment account, only the amount would change. Now let us look at issue of shares at discounted rate. So what do we mean by issue of shares at discounted price? When the shares are issued at a price lower than the face value, then those shares are said to be issued at a discounted price. Face value will be less than issue price. Therefore, the difference would be treated as discount amount. But after the introduction of Companies Act 2013, especially the section 53 of Companies Act, shares can no longer be issued at a discounted price. Therefore, any issue of shares at a discounted price will be declared as void, except in case of sweat equity shares. We'll look into that aspect later. Now let us look at undersubscription of shares. So what do we understand by undersubscription? When the number of shares applied for by the public is less than the number of shares issued by the company, then that will be known as undersubscription of shares. Let's say the company had issued 1 lakh equity shares and it received only 90,000 applications from the public. In that case, it is undersubscription. SEBI, that is Securities Exchange Board of India, has fixed a minimum subscription limit as well. If any IPO does not get that minimum subscription from the applicants, then that IPO would be deemed as null and void. The limit fixed by SCBI, that SEBI, is 90% of the issued amount. If 1 lakh worth of shares is issued by any company, and if only 80,000 worth of shares is subscribed by public, then that company's IPO would be declared as null and void. But if it receives at least about 90% of issued amount, then that IPO would see the light of the day. In fact, very few companies get under subscription. Very few companies' shares are undersubscribed. But one such example is the Goodwill Hospitals, which had an IPO to the extent of 34 lakh shares, and it only received applications to the tune of few thousands of shares way back in 2012. Now let us look into oversubscription of shares. Oversubscription is that situation where the applications are more than the number of shares issued. For example, if the company issues 1 lakh shares and if the applications received by the company is 1,50,000, then that is a case of oversubscription. Once again, as we can see here, when the number of shares applied for exceeds the number of shares issued, that is 1,50,000 as against 1 lakh. That excess amount will be allotted by the directors on a reasonable basis, that is pro rata basis, wherein if you apply for 5 shares, you might get 2 or you might get 3. That is called pro rata basis of allotment. That will be decided by the directors. Moreover, as per the SEBI procedure, following 3 things should be adopted, either of these 3. First is total rejection of some applications. Let's say you have received 150 as against 1. In such cases, the company can totally and outrightly reject the excess 50,000 applications. Or acceptance of some applications. That's the other face of the same coin, wherein you reject few and you accept some. Or we can allot on the basis of pro rata allotment. Or what we can do is we can allot shares based on the pro rata basis. So if you take the same example of 1,50,000 and 1 lakh, let's say 1 lakh shares were invited by the company and received was 1,50,000. The company can totally reject some applications outrightly, say 25,000. So remaining is 1,25,000. Now, acceptance of some applications. What we do is out of 150, we have only accepted 125. So, but we only have 1 lakh shares to allot. In such cases, what we will do is we will make use of pro rata allotment method, wherein we are proportionally allotting shares to the applicants. If you apply for 125, you will get 100 shares. That is ratio of 5:4. Apply for 5, get only 4. So oversubscription is something which happens naturally. Only the number of times a particular IPO is oversubscribed changes. Sometimes a particular IPO will be oversubscribed many times, like in the case of S-Change, where it was almost oversubscribed 60 times. And in some cases, it will be oversubscribed only 1.5 times, 2 times, etc. Now let us look at an example of pro rata allotment of shares. This is once again a crux, and this format can be utilized wherever you encounter a pro rata based type of allotment of shares. So let us look at the example. A limited company issued 1 lakh shares of rupees 10 each. Rupees 3 on application, rupees 2 on allotment, and rupees 5 on first and last call. Now, towards those 1 lakh shares which it invited, the company received 1,50,000 shares. The company accepted only 1,25,000 applications, out of which towards 75,000 applications it allotted in full. So if you had applied for 1 share, you would have got 1 share. Towards the remaining 50,000 applications, it allotted on a pro rata basis only 25,000 shares. That means if you apply for 2, you will only get 1. 2:1. Whereas here in the category 1, it is complete allotment. And the last category is complete rejection, wherein even if you applied for any share, you wouldn't be allotted any share, because those 25,000 shares were outrightly rejected. Now let us look into the journal entry which we have to pass for the same. First of all, let's receive the money, because we don't have any control over this. So how many applications did we receive? 1,50,000. What was the application money? Rupees 3. Therefore, we have received 4,50,000. And credit the liability, increase in liability, that is share application, 4,50,000. Now, how do we appropriate or apportion this 4,50,000? That is the question. First of all, we have to debit the share application account, 4,50,000, once we try to appropriate the same. Credit share capital. See, we only have 1 lakh shares to be issued at the rate of rupees 3. Therefore, we have to credit that much to share capital account. But in that 1 lakh, there are 2 types of shares. 75,000 shares or applications to which we have allotted in full, and 50,000 applications for which we have only allotted 25,000 shares. Therefore, 75 plus 25 into 3 lakh rupees. And whatever the excess which we have received from category 2, that is 2:1 pro rata allotment, will now be apportioned towards share allotment account. excess money received towards those 25,000 shares, rupees 75,000, will be credited to share allotment account. We have already created this liability, though we have not yet asked the public to pay the money for share allotment, because at the time of application itself, we have now received the allotment money as well to the extent of these many shares. And lastly, the rejection, that is outright rejection of 25,000 applications. So since we are returning the money, we have to credit bank account to the extent of 75,000. Now let us look at calls in advance and calls in arrears. What is calls in advance? It is the money received by the company in advance from the shareholders. That is, though the money is not yet due from them, that is from the shareholders, the company has already received that money. For example, let's say the company has not yet made the first call, but the shareholder has already paid that first call money along with the allotment stage money itself. Then it is said to be calls in advance. Calls in advance will be a liability to the company, because though it is not yet due, it has already received the same. But it should be noted that no dividend should be paid on such calls in advance. But as per table F, it is said that the company is liable to pay interest but not exceeding 12% per annum to the shareholder. Likewise, we have calls in arrears as well. Calls in arrears is kind of opposite of what is calls in advance. That is, if the shareholder defaults in sending the call money to the company within the appointed date, then that is said to be the calls in arrears. For example, the company has called the first call money, but the shareholder hasn't yet paid that call money. Then it becomes calls in arrears for the company, because that money was due from the shareholder, but they have not yet paid the same. Again, as per table F, the shareholder will be liable to pay the interest at not exceeding 10% per annum, or as the board may determine. Now let us look at a problem based on calls in advance. Again, this is a crux. That means you can follow this format for pretty much any problem involving calls in advance. Let us look at the problem first. A Limited made a call on 1 lakh shares for rupees 3 per share for the first call, but it received rupees 3,50,000. Here itself we can notice that there is an advance. They were supposed to receive 1 lakh into 3, that is rupees 3 lakhs, but they received 3,50,000. That is rupees 50,000 is the calls in advance. And they also made a second and final call after 2 months for rupees 2. Interest on calls in advance is paid at 5%, they say. Now let's look at the journal entries. First of all, we have to pass the receipt entry. So whenever we receive money from the shareholders, our bank balance will increase. Therefore, if asset increases, we have to debit. So therefore, debit bank account. 2. Share first call 1 lakh into 3, because we had already created an asset, and now at the time of passing due entry, now that asset is getting reversed or nullified to the extent of 3 lakhs, because only that much was due from the shareholders. Whatever is the difference between these two, that is 50,000, will now be treated as calls in advance. Calls in advance is a temporary liability. So this calls in advance will be apportioned to the next, that is the second and final call. So until then, it will be treated as liability. After this, the company also made a second and final call after 2 months for rupees 2 per share. Now let us look at the second call. First, we have to pass the due entry. Share second and final call account debit 1 lakh shares into rupees 2 per share, 2 lakhs. To share capital 2 lakhs. But before we pass the receipt entry, we have to adjust the calls in advance against the second and final call. So let's adjust this. So it had become a liability. Now that we are utilizing that liability towards second and final call, we have to decrease that liability. Therefore, decrease in liability has to be debited. So debit calls in advance 50,000 to second and final call. We are apportioning that 50,000 towards second and final call. After this, we will receive the balance money, that is 1,50,000. After this, we will receive the balance money, that is 1,50,000. So debit bank, because increase in asset, and credit share second and final call, decrease in asset. Lastly, we have to pay interest on calls in advance as well, because we had received calls in advance and we kept that amount for 2 months. Therefore, on that advance money of 50,000, we have to pay at the rate of 5% per annum for 2 months, which comes to 417. Therefore, in this case, the entry would be debit interest on calls in advance 417. It's an expenditure. Therefore, increase in expenditure should be debited to bank account because decrease in asset. Since we are making that payment, our bank account is getting reduced. Therefore, credit bank account. Now, let us look at problems based on calls in arrears. A Limited made a call on 10,000 shares for rupees 3 per share, but there was arrears to the extent of 1,000 shares, totaling to 3,000 rupees. The arrears money was received after 2 months. Interest on calls in advance is paid at 5% per annum. If you look at the entries, first we have to pass entry for the amount received. Debit bank increase in asset once again. 10,000 into 3, we were supposed to receive 1 lakh, but we did not receive to the extent of 1,000 shares. That is 1,000 into 3, 3,000. Therefore, we only received 97,000. Therefore, bank has been debited only to the extent of 97,000. Next comes that 3,000 which was not received. That is nothing but an asset which we are creating in the name of calls in arrears. Because it is nothing but the money which we were supposed to receive but we did not receive. And finally, credit the decrease in asset. We would have already debited share first call account at the time of due entry. Now that thing is being reversed here. Next comes the receipt of calls in arrears with the interest. So when we receive this 3,000 later, that is after 2 months, we will receive that along with the interest. So if you calculate interest on that, that is 3,000 into 5% for 2 months, it will come to 25. So we are receiving 3,000, that is the amount which was due, plus interest 25. Therefore, amount received is 3,025. Therefore, debit bank account 3,025. Then credit calls in arrears, decrease in asset, because we had created an asset saying that we are supposed to receive this much. Now that we have received it, we have to reduce that asset. And finally, interest on calls in arrears is nothing but an income. Since increase in income should be credited, we have credited interest on calls in arrears.